Markets start the week on a high as the end of the US shutdown could be in sight. The US Senate passed the first stage of a deal on Sunday night that would finance the government until the end of January and end the longest shutdown in US history. That was a shot in the arm for markets that wobbled last week on nerves about whether the valuations of AI-related stocks are really justified. Well, Michael Browne is global investment strategist at Franklin Templeton. Michael, historically, US shutdowns have had little impact on markets or the wider economy, but has this one go on for so long that it's made a difference at the macro level?
I don't think so, to be quite honest with you. I think it's going to be rather more of the same, and we've always seen at the end of a shutdown markets rally somewhat. And I think we're seeing exactly that today.
Government bond yields are rising too this morning while equities recover. Is risk-on sentiment coming back after a wobble last week?
It is, but one word of caution. As a result of the government shutdown, we have had no data. We are flying blind, so to speak. We're going to get a slew of data about the US economy over the last 2 or 3 weeks. So expect an awful lot of economists doing an awful lot of catching up and trying to see exactly where things are. The indications are that growth is pretty good in the US at this point in time.
Do you think then that the Fed is on the right track, or do you think they might be looking at those numbers and thinking, oh no, we should have cut further and sooner?
Well, it's finely balanced, as the Fed has said on several occasions. The bottom line is that we haven't had the inflation that everybody forecast that would occur after tariffs, and it doesn't seem that we're going to. Therefore, the current interest rate is just not necessitated, and thus that you have the huge debate over what actually the long-term real base rate is. What's that neutral rate?
A survey from Business Europe said today, though, Michael, that European companies would see greater impact from US tariffs next year than they have this year. What do you make of that?
No, I think that's probably about right. And we've had several companies report in this quarter's numbers showing exactly the hit that they've taken to profitability as a result of the tariffs. So in other words, the corporates are wearing those tariffs at this moment in time. They're not passing them on to customers. Now, the bears will say, oh, well, that means they're going to put up prices later. But I would say that's it. You've had to wear the cost. Now take it out of your P&L rather than the other way around. So unfortunately, the evidence seems to suggest that tariffs from a US perspective are working.
What do you make of the earnings season so far more broadly? I thought it was interesting that you noted many European companies have upgraded forecasts, but not for now, for the second half of 2026. So is the nearer future just too difficult to predict?
Well, you're absolutely right. We've actually had a pretty decent set of numbers this quarter from Europe. And by the way, we had a very good set of numbers from the US as well. So the backdrop for earnings now into 26 should be improving. Yes, it is in the US, but analysts in Europe seem to be amazingly reluctant to raise their numbers at this moment in time. And yet we've got the tariff information. We know what the currency strength means. So why is that? I think there's some value here in Europe that we're just not exploring here, and analysts' reluctance gives us an opportunity.
There's been a lot of talk this year about an end to US exceptionalism, but what we've seen over the last couple of weeks is that stocks still rise and fall everywhere based on the performance of the Magnificent Seven in the US. Is volatility in those stocks going to encourage a rethink, do you think?
But we've done some work on this, and we've looked at correlations going back to 2008. And amazingly, since 2008, equity markets around the globe have become more correlated to the United States, not less. And given that you've had the growth of the Magnificent Seven, they didn't exist in 2008, given that that's a unique US phenomenon, you think that's deeply counterintuitive. It is, but here we are in a Fed rate cutting cycle. What does that mean? That markets will react to those US rate cuts and will react quite quickly. And over time, and we're going back into history, we found that the emerging markets do by far and away the best from a series of US rate cuts. So that's what we're talking about at this moment in time. Yes, more correlation, counterintuitive, great for global markets as well as the United States.
That was Michael Browne of Franklin Templeton. Don't forget, you can watch more videos on Reuters.com.